Thank you, Lewis and Brian, for that excellent discussion. Okay, next up, you can see the panel is ready to go, and it's a session I've been very much looking forward to. If we are to realise the net zero ambition, it's imperative that we reset finance behind a more long-term ESG-driven strategy. And up next, I'm pleased to say we've got a panel of speakers to share ideas and actions on how they are helping hopefully move capital markets behind a clean recovery. On your screens now, you see Dave Zellner, the Chief Investment Officer at Wespath, Sarah Bratton, the Head of Sustainability North America at Schroders, Victoria Mills, Managing Director at EDF, and Alexa Yigit, the Head of Sustainable Finance, CECP CEO Investor Forum. It's a 45 minutes discussion. It's live, and they're here to answer some of your questions. So do use the Q&A box to the side, and we'll try and get some of those questions asked at the end of the discussion. But now it's my pleasure to hand over to you, Alexa.
Thank you, Liam. We're excited to be here today. Our conversation will address how achieving net zero emissions by 2050 will require aligning investor expectations and ESG performance measures behind the same goal. We will take a deeper look at how leading investment institutions are putting ESG at the heart of their investment strategies and what it means for corporations and their approaches to mapping their disclosures to their net zero emissions goals. As the why is quite clear, our esteemed institutional investor and NGO panelists will share how they are proactively assessing company environmental disclosures as part of their investment decision-making process, and how companies can position themselves to meet these expectations and their climate goals. We have a lot to cover within these 45 minutes, and we'll try our best to entertain a Q&A at the end of the session. However, should we fall short on time, we will ensure that all questions are answered following the session. So with that, I'd like to turn it over to the panel and get started by taking a look at the state of the market. An estimated 200 new funds in the US with an ESG investment mandate are expected to launch over the next 3 years, and ESG mandated assets are set to grow 3 times faster than non-ESG mandated assets, set to comprise half of all professionally managed investments by 2025. So Sarah, from your perspective, what would you say is driving this growth, and what are some key trends in green finance you're seeing and focused on across the asset classes?
Great, thank you, and thank you for having me here today. I'm excited to be on this panel. I think to really just break it down, there are 3 main drivers, in my opinion, to what is driving this growth. Regulations, consumer demand, and economics. And I'll break down each one of those 3 of them. So first, on the regulation part of it, you've seen this global surge in regulatory demand. So in regulations around sustainable investing and ESG investing. So if you just went back to 2017, there were about 100 policies globally around ESG and sustainable investing. That number has exploded today, more than doubled, and we're looking over 200 regulations just in 2019. And I think everybody on this call can agree that the regulatory environment around sustainable investing is just becoming greater and greater. We'll put the US aside for a second. We can talk about the different regulations here. We're a little bit at odds with the rest of the world because the majority of those policies are favorable. And I think most famously, or the largest one, is the EU Sustainable Finance Initiative, where not only are they looking to increase disclosure around these issues, but there's also a clear mandate to move capital from quote unquote brown industries into green industries as part of that broader bill. To keep this concise, I would say the second bit of it is consumer demand. So I think of consumer demand and end client demand along the spectrum of the A, B's, and C's. So if you think about where SRI investing started, it was the A. So that was the avoid. That was what sustainable investing or SRI investing was back in the 80s or 90s. We moved on to the B, which is the benefit, and that's the integration. So that's really looking for the pure financial benefits of integrating sustainability into your return. Where we're going is towards that C, so finding solutions that contribute to this. So I think you're seeing increased consumer and client demand. We do a global investor survey every single year here at Schroders. 2019 was a shift for us where we saw the Gen X take over the millennials and the women for having demand. I think a lot of that had to do with climate. A lot of Gen X, whether they had children, nieces, nephews, friends' children out doing these climate protests along with Greta, they were finally looking back at themselves saying, how am I going to make this world a cleaner, better place? And then not only that, we've seen that double down in 2020, and actually over 55% of Americans are now saying that if they don't invest in sustainably, they will lose out on return. So that's a clear shift we've seen in that mentality that sustainable investing has cost you return. So again, you have that consumer demand, pent up demand there. And then there's the economics, right? None of this is going to work unless the economics work. So you've seen sustainable investing prove as no longer a bull market luxury throughout the crisis that we've had here. You've seen NextEra, which is our largest alternative energy producer here in the US, surpass Exxon on the S&P 500. That just happened this past month. And if you think about just what you have seen in terms of the amount of money that is going to be in motion if we want to meet the environmental goals that we have by 2050, that's over 100 trillion of investable opportunity. And I think people are beginning to awake into that. One of our portfolio managers here, actually, Simon Weber, I will plug him. He did a great article on decarbonization being the next big mega trend that we will see in the market. So again, I think you can, well, there's many drivers. If I was going to sum it up to three, it would be regulation, and client consumer demand, and the economics just work now.
No, that's very interesting. Thank you for sharing that. I think also building on shifting from using ESG as a risk mitigation tool, which is great to see, it's also becoming that more proactive. How can we contribute? We see that behavior across institutional investors and their portfolios as well. We'll get into, the going from exclusionary restriction screening to more impact and thematic investing in just a second. Before we do, I just wanted to get Victoria's take on building on these key drivers that Sarah's mentioned. Why are investors increasingly interested in corporate net zero ambitions, and how are they engaging with companies on the topic to ensure these expectations are met?
Sure, and thank you for having me as part of this discussion as well. To build on what Sarah was saying, I would add another driver that really underlines all three that she mentioned of regulations, economics, and consumer demand, and that's just the recognition of the risk of unabated climate change. I think everybody from investors to consumers to economists, businesses recognize that climate change is no longer some abstract threat that maybe affects future generations. It's happening right now. It's destroying shareholder value right now. It's harming our economy right now. We're on track for a record-setting year of destruction in 2020 between the wildfires in California, hurricanes in the Southeast, and that threat will only grow. Just last month, the Commodities Futures Trading Commission put out a report saying that unabated climate change threatened to destabilize the entire financial system. And they recommended that the number one way to reduce climate risk is through climate policy and putting a price and limit on carbon emissions. So that's really significant. And I think the policy piece is critical because we will never get to net zero without it. You've seen a lot of voluntary pledges by companies to meet net zero, and they are very important. But they won't by themselves get us anywhere near the deep decarbonization that we need to limit warming to 1.5 or even 2 degrees. For that, we need public policy to provide regulatory certainty, drive investment, drive innovation, and decarbonize our energy and transportation and industrial systems. So, how does this affect businesses? Well, businesses have a really powerful role to play in advancing and supporting the public policy changes that we need to get to net zero. In fact, I would argue that the most powerful tool companies have to fight climate change is their political influence. And I think this is something that investors are picking up on because they are starting to ask companies, not just what are you doing to reduce your own emissions, but how are you working to advance the policy changes that are needed to get to net zero. And for 2 years running now, the Climate Action 100 plus investors have put out a letter to major emitters. Dave, I don't want to steal your thunder. Maybe you're planning to talk more about this yourself, but asking major emitters to disclose how are you lobbying? How is your lobbying consistent with Paris goals? How is your trade association lobbying consistent with Paris goals? So I think that is something that is going to be an increasing trend going forward.
Absolutely. I think two key takeaways from this session is of course, the public policy, which we will get Dave's thoughts on in just a moment, but also the mobilization of capital to gear towards those new and innovative solutions of sustainable finance. Looking ahead, Victoria, what will the environmental community expect from companies and investors? And what does this say about the impact of the momentum stakeholder capitalism is gaining?
Well, I think the bottom line is that climate leadership today requires policy leadership. And NGOs and increasingly investors, I think, expect that that companies have a science-based emissions reduction target and a science-based climate policy agenda to match. So what is a science-based climate policy agenda? So here's where I'd like to introduce what we call the AAA framework for climate policy leadership. And this is something that's endorsed not just by EDF, but also by the major environmental and sustainability groups that work with business. So Ceres, BSR, CDP, C2ES, WWF, WRI, and others. And so what the goal of this framework, obviously, is achieve net zero emissions by 2050. And the 3 A's in the AAA framework are: first, advocate for policies that are consistent with net zero, align your trade associations lobbying behind the same goal, and allocate your spending to advance climate policy and not obstruct it. So this is something that we have been promoting, and our latest tool that EDF has put out for kind of highlighting examples of what science-based policy advocacy looks like is our climate authenticity meter. And you can find that at climateauthenticitymeter.org. And what this tool does is highlight examples of public policy advocacy that's either advances or obstructs progress toward climate policy. So a couple of examples of highly supportive actions are the 5 automakers that signed an agreement with California to continue reducing their greenhouse gas emissions despite the administration's rollback of the clean car standards. They are investing in innovation rather than litigation, and that is real leadership. Another example, more than 30 companies signed an open letter to members of Congress in July asking them to include support for clean energy provisions as part of COVID recovery spending. Highly supportive of progress. Some examples of obstructive actions, by contrast: recently, the US Chamber filed an amicus brief joining litigation against state authority to set vehicle emission standards. Not helpful. Another obstructive action was the Chamber supported a Department of Labor rule that would limit employers' ability to provide ESG funds as part of their retirement accounts to employees. Now, this policy would penalize companies that invest in improving their ESG performance and reward companies that don't. So that's not helpful. Mm-hmm. So those are some examples of policy actions that we believe are either supportive or not so.
Great, thank you for that. Wanted to change topics for just a minute. The wide range of reporting metrics can cause confusion for companies as well as lead to challenges such as greenwashing that ultimately stand in the way of true progress. Sarah, this question is for you. How are investors holding companies accountable in demonstrating actual implementation of their net zero ambitions?
So I do think that this, and I'm sure we will all hit on this greenwashing topic because it's becoming a greater and greater topic here in the market. And us as Schroders, we do applaud when companies make these big, bold statements. But I'm sure as both my panelists can agree, words only mean so much. And we're really focused on the action. So here as an asset manager, we have been heavily developing our suite of climate tools that we use to analyze our investments, acknowledging that there is no silver bullet to analyzing climate risk across companies. So we have everything from our climate progress dashboard, which is measuring the speed and scale of change. So think of it as assessing that timing question, to a holistic time toolkit, looking at a carbon value at risk, looking at physical risk, looking at alignment to the goals of Paris. So we're looking across a wide range of impacts. And I think it is very important to us, and Victoria hit on this, our analysis has concluded that the investment implications of these impacts could cost global listed companies up to 20% of their market share. And that's the broad global. It's when you look at it on a sector by sector basis, it gets a little bit scarier for a lot of these sectors. So we're not just looking at what companies are saying. We actually like to see it embedded throughout the investment, throughout the risk of the organization. So throughout their risk aligned processes, we like to understand how they're embedding it throughout the organization, how that is reporting up through management, who is accountable for it, and who on the board is also accountable for it. So, and we'll look at companies versus different climate scenarios. So not just what they need to look at by, we'll look at what they need to do by 2030 and 2050, and then we'll also assess what is the actual likelihood of these big statements they're making actually coming to fruition by those certain dates. So we're not just trusting that because a company or a management team is coming out to say it, or sometimes a marketing department is coming out to saying that the companies have these really ambitious targets. For us, it's about engaging with these companies, really understanding, talking with the management teams. And when we don't think that they have taken this serious enough, as an active owner, we're going to vote against, or we're going to sell the security, right? There's no voice like your vote.
Yeah, that's very insightful. It seems that it's no longer just about the data, as you mentioned, but future scenario analysis that really enables companies to look around the corner. It seems like that's what institutional investors are increasingly demanding. So for example, the TCFD requirement of scenario planning, what is your take on this, and how are asset managers integrating scenario planning into their investment decision-making process alongside the data? Sarah or Dave, do you want to kick us off with that one?
Sure. Alexa, happy to be able to respond to that. I think there are two barriers that are standing in the way of asset managers evaluating scenario planning by companies. I think the first one is the fact that they're incented to more of a short-term orientation. Oftentimes, asset managers are looking at quarterly earnings and not focusing on the long term. And so the inherent structure in terms of how they're compensated and how they're retained or hired by asset owners is one that negates their focus on long-term scenario planning. But I think the second reason is that we're not seeing enough companies doing sufficient scenario planning. Victoria mentioned the Climate Action 100 Plus, and as a member of that organization, we and other asset owners have been engaging with companies for years, asking that they conduct robust scenario planning and report the results of their planning to shareholders so that the shareholders can assess the risks. But the reality is that we still don't have enough companies that are doing robust scenario planning. And so the next step is to file shareholder resolutions, and there have been a number of shareholder resolutions filed asking companies to do more robust scenario planning. We do see the recent announced collaboration between the Climate Action 100 Plus and the Transition Pathway Initiative to create net zero benchmarking for all Carbon Action 100 Plus companies. It's an important evolution in the industry. And once we have this information next year, we're certainly going to be pressuring our asset managers to inform us how they are considering that information in making investment decisions and decisions regarding retention of the companies in their portfolios.
Great. Sarah, would you like to add anything on scenario planning?
No, again, I think it's that, and I think Dave brought up a good point, and it's that active ownership point, and that not being afraid to file the resolutions to continue to put pressure on these companies to provide that scenario planning. And for us as an asset manager, this is a big part of, and we're a active only, long only asset manager. So this is a big part of what we do. And I think that time horizon period, I think also sort of hits the nail on the head. And I also think it hits what Victoria said early on, is that this is no longer a risk that we can't pay attention to. And I always say, as a millennial, I'm not retiring anytime in the next 10 or 15 years, right? So I want my retirement invested with asset managers and with fiduciaries that are taking account these risks in their investment process when they're assessing it. So for us, it's again continuing to engage with. It's building our own tools, because it's that trust but verify, right? We're not just going to trust what a management team is coming in and saying us. One of our portfolio managers said, you only really know 30% of what they tell you is only 30% of what's going on under the hill. So it's working with different initiatives to really put that pressure as an asset management and asset owner community on these companies to disclose more, to do this scenario analysis, and then looping it back into the investment process. Because unless that is embedded in the investment process, you can have asset owners go out and sign all of these different pledges. But unless that's making its way back into the investment process, at the end of the day, it's sort of a moot point.
Absolutely. And I think that's something at CEO Investor Forum we take quite seriously in preparing and trying to shift the market expectations from short-term to long-term shared value creation. And I think looking around the corner through scenario planning enables companies to disclose proactively how they plan on meeting those challenges head on, instead of just, dealing with it in the moment as a reactive approach. Sarah, you've done research on, Victoria, you've done research on corporate sustainable rankings and ratings and reporting frameworks. What did you find, and what does it mean for investors trying to distinguish themselves from laggards in addressing climate change?
Well, I think this is one of the things that we looked at is, first of all, the most widely known rankings of corporate sustainability performance. So as distinct from ratings that investors use, how do companies kind of keep score, and how does the public and how do investors more broadly keep score of leaders and laggards on corporate sustainability? And what we found in our report that's called The Blind Spot in Corporate Sustainability Rankings is that they do not include climate policy advocacy as a measure of leadership, with a few exceptions like Influence Map, which is strictly focused on that. They generally leave it out. And that's how you can get companies that sometimes rank highly on corporate sustainability rankings, like Dow Jones Sustainability Index or 3BL Media's Best Corporate Citizens, or Barron's or Corporate Knights or what have you, that are either doing nothing or sometimes even working to oppose climate policies, which is really unfortunate. So we are now EDF is working with a lot of those rankings to integrate the AAA framework that I mentioned earlier. And there are ways that rankings can and must integrate policy advocacy as a measure of leadership. I think ESG ratings have been slower to catch up to where leading investors are on this issue. And I think part of that has to do with the time horizon challenge that both Dave and Sarah mentioned. They tend to be focused just on, what is happening or what has happened in the immediate future. I think the definition of materiality is way too short term. That's something that the Commodities Futures Trading Commission also highlighted. And, there's this sort of nearsightedness about climate risk. And I think that the sense of what needs to be accounted for and how you reduce climate risk. And yes, you can reduce climate risk by reducing your own emissions as a company, but unless you're also addressing the system-wide risk and working to advance public policy, you're not safe, and your investors are not safe from climate risk.
Absolutely. And there with more effective communication and disclosure on climate policy, it's not only a blind spot for investors that can result in, but also a missed opportunity for the company as well. So shifting gears, when it over to Dave. When it comes to the impact of climate change that it can have on companies and financial markets more broadly, do you see any barriers that prevent asset owners and asset managers from successfully addressing the systemic risks brought on by climate change?
Yes, Alexa, thank you for that question. Definitely. Now, in my last response, I pointed the fingers to asset managers for having this short-term view, but the reality is the fault belongs on us asset owners. Because even among investors that truly profess a long-term orientation, the pressure to produce near-term benchmark-meaning results inherently conflicts with the investment community's need to influence change that result in long-term sustainable market returns. For years now, I've been saying that investors collectively spend too much time focused on alpha, which is a zero-sum game. In fact, it's a negative-sum game when you consider transaction costs and investment management fees. And they're hardly spending any time focusing on the beta of the market. And so if asset owners and managers collectively act to try and shift the markets to promote a sustainable long-term economy, at Wespath, we believe that in order to meet the investment return assumptions of our participants and other stakeholders, that we have to have a sustainable economy. And we just define that as social cohesion, prosperity for all, and environmental health. And that necessitates taking a long-term view. But the reality is that people in my position as a chief investment officer and their staffs are incented to produce near-term benchmark beating results. And they, in turn, pressure their managers to produce near-term alpha so that they can demonstrate that they're effective in their asset manager selection decisions. We as an industry have to move away from focusing on near-term results and focus more on the long-term, what's required to achieve long-term sustainable economy. And until the incentive structures change in terms of the hiring of asset owner people in my position, and in terms of hiring the asset managers, we're not going to be able to erase those barriers that are precluding us from achieving the policy changes that are necessary to achieve a sustainable economy.
That's great. You recently mentioned that in meeting investor expectations, that can sometimes serve as a competitive disadvantage for companies. Can you share more on that, and how can institutional investors leverage public policy to level out the playing field in order to achieve the objectives of the investor community?
Sure, Alexa. Victoria mentioned the Commodities Future Trading Commission report. It was 196 pages on managing climate risk in the US financial system. And it emphasizes that the incentives inherent in the current system are counter to addressing climate risks. And the financial markets can't effectively price those risks on their own. And the report states, and I'll quote, "Until this fundamental flaw is fixed, capital will flow in the wrong direction." And so with our various partners in the US and around the world, we frequently engage with companies regarding changes to business policies that align with the aspirations of Paris. But what we frequently hear is generally agreement with the direction that we need to go. But we also hear that there's difficulty in doing so because the incentives and disincentives that are not there in public policies. Companies will tell us that they have to have a level playing field so that they are not placed at a competitive disadvantage by aligning with the goals of Paris. Now, I have to add one additional comment, and it goes to echo what Victoria had said a little while ago. It's really frustrating to hear these same companies that say, yes, we get it. We need to align with Paris. That's the objective that we should shoot for. But then they continue to fund some of these trade associations that actively lobby against the very public policy changes that they agree would level the playing field.
Absolutely. There needs to be a balance there. Over to Sarah and Dave. This question is for both of you. Over the past 5 years, we've seen institutional investors shift beyond what has been traditional responsible investing, which focused solely on exclusionary restriction screening of those more brown investments, to more explicit and proactive approaches, including thematic and impact investing. How does your approach to your investment selection process or those of your asset managers with Schroders and at Wespath, how does that align with your purpose and core impact objectives? Do you specifically focus as well on any of the environment-related SDGs? Sarah, why don't you get us started on that one?
Dave and I are looking at each other. Who's going first? Schroders has been involved in sustainable investing for over 20 years. It is part of our European roots. We did hire our first dedicated team member back in 1998. So much like Wespath, this is something that we've been committed to for a really long time. I'm sure Dave will say too, we've probably never been more popular as people begin to realize the risk that is out there in the market in terms of risk, but also the opportunity for investments and for changes. So this is not this whole crash into or whole buildup of sustainable investing is nothing that is new to us here. And it hasn't changed the way we've invested for a number of years either. What we are continuing to do over here is to continue to build out our toolkit. So we've committed to 100% integration throughout all of our managed strategies here at Schroders by the end of 2020. We're at about 98% right now. So that's across all of the asset classes, and we have over 40 different investment desks here. So it's something that we're truly committed to doing. And we're truly committed to doing because at the end of the day, and for those past 20 years, we've truly believed that this will lead to better long-term risk-adjusted returns for our clients over time. So it's not something that we're just jumping into the fad doing. And so it's embedded in everything that we're doing here. We are trying to identify those companies that are not only going to survive, but thrive in the future. So we built up a robust toolkit to help us do it. And I know it's so easy, and I know we are on a net zero call, and I want to say we just focus on the G, but that's not, on the E, but that's not it for us here at Schroders, right? It's about that holistic assessment of a company. So one of our flagship tools, SustainX, which quantifies the externalities that companies create across 40 different measures of impact, both on the environmental and the social spectrum. It's calculating the externalities that companies create and saying at the end of the day, if all of these were passed back on to companies in the forms of environmental or social regulation and or boycott protest, what would be the impact to a company's listed earnings? Well, globally, 1/3 of the companies would be in the red, right? So this is something for us as asset managers. It's within our responsibility to be taking account all of these risks, both on the environmental, social, and governance side, because at the end of the day, they're linked, right? Climate change is going to impact the most vulnerable amongst us in society. It's clear. We've seen it happen. So these, and then if you think about it from a governance perspective, we want to see all of these, how a company, a management, a board is addressing these E&S issues up at the top line, at the governance. How is that feeding up? How is that embedded in a company's enterprise risk systems? So for us, I wish I could say it was just about the E, because we are on an environmental call, but it's not. What we are doing is understanding, I talked about the A, Bs, and Cs, right? We are seeing a tremendous opportunity in terms of disruption, new technology from an investment perspective in the C section. So we've had a global climate change fund for 10 years, over 10 years now. We have an energy transition fund. We have impact products with our Blue Orchard, who's one of the leading impact managers. They're a Schroders company. We have impact products focused on sustainable infrastructure in emerging markets with a real focus on climate resilience, building these products up. So we have the product suite there, but it's not just about the product suite. It is literally embedded in all of our core investment processes here to take into account these risks and responsibilities, these risks and opportunities within our investment process.
That's very interesting, and I think you hit the head on the nail. It's that holistic lens. It's not just about, again, we're on a call about the net zero ambitions and the emissions, the commitments coming out, but more so it's all interconnected. You need to address the S, the G alongside the E if it's going to be a long-term solution for your company, and that's what investors are increasingly interested in. Dave, would you like to contribute to this question as well?
Sure. So for those who don't know who Wespath is, they're the agency of the United Methodist Church that manages the pension and health benefit assets for the 100,000 clergy and lay employees of the United Methodist Church. And for a long time, we called our program a socially responsible investment program. Now, at the beginning of the call, Sarah talked about the ABCs: avoid, benefit, and contribute. And so we actually purged any reference to socially responsible from our investment policy. And we wanted to talk about sustainable and responsible, because we definitely believe in what Sarah talked about, the benefit and the contribute. And so the mission of the United Methodist Church is transformation. It's to make a world a better place. And so, yes, while we still avoid some of the major industries, the focus of our program is on engaging, which I've already talked about, but then also investing in a manner that has a positive impact, recognizing that we have to attain market rates of return. For 30 years now, this year we're celebrating the 30th anniversary of our positive social purpose lending program, where we have originated loans for low and moderate income housing. We've invested over $2 billion over the years. And if you're focusing specifically on the sustainable development goals, we think that this is helping to address goal number 1 and number 2. But in addition, we're also investing in what we believe are low carbon transition investments. We have a set of 10 investment beliefs. We think that best practices define those beliefs. We do believe that the world is transitioning to a low carbon economy and that there's risks and opportunities associated with that transition. And so as a result, we've invested with a number of different investment strategies, but notably we have a enhanced passive strategy with one of the largest index providers in the world that identifies data reported by companies and identifies those companies that are preparing for this transition to a low carbon economy. And so what we do is we overweight the companies that we believe, based upon the data that they were reported, indicate that they are well on their way of transitioning to this low carbon economy. And then we underweight the companies that we don't think are on a path towards this low carbon economy. So those are the type of things that we're doing. That's where we're placing our emphasis. It's more on the benefit and contribute that Sarah talked about, as opposed to the avoid part of the equation.
Excellent. My next question is for all three of you, and it's a good segue from Dave, what you just said. Taking the long-term view, Victoria, if you could get us started in sharing, how do you see environment-related disclosures shifting over time to address global cross-sector challenges, including climate change and the need for resiliency among corporates?
So I think where we are right now is we have in disclosures asking about current greenhouse gas emissions and current climate risk. We need to integrate the policy piece. And you'll see investors are already asking companies to disclose that directly, supplementing whatever information they get from reporting frameworks and ESG ratings. I think that this will just become the norm. I think the whole suite of what is your science-based target, what is your net zero goal? Like Sarah said, how are you planning to achieve it? What is your transition plan? And how are you pursuing and advancing the policies that are needed, not just to achieve your own net zero goal? Let's say a company sets a net zero goal that includes 100% renewable energy. Well, what are you doing to support the policies that will drive they'll give you the renewable energy that you need, and boost the market, and support policies at the federal and state level that are necessary for that transition, or support electrification of the transport sector and decarbonization of the electricity sector. So that's what I think NGOs want to know, investors want to know. And I think we'll see a transitional phase where leading companies start disclosing and reporting on that stuff voluntarily. And then you'll see the ratings and reporting frameworks and scorekeepers kind of catch up.
That's very interesting. So it's basically understanding as a corporate how your decision across your climate policies, your agenda, your commitments to achieve net zero ultimately impact, your ecosystem around you. Dave and Sarah, any additional comments on the future of climate change related disclosures?
Go ahead, Sarah.
I was going to say, I bring it actually right back to the first question. And I think I believe what Victoria said, this is going to become in 5 or 10 years, the status quo, but there's going to be some disruption before we get there. So number one is the regulatory piece. So I do think in terms of climate disclosure, the EU Sustainable Finance Bill has the ability to be have a large impact on that, because it's not just an EU bill. Many people think it's only relevant to asset managers that are headquartered over there. No, every asset manager that has over 500 employees that's licensed to distribute a product in Europe has to abide by these disclosures. So as asset owners, we're going to be asking a lot more of the companies that we're invested in. So it's not just Schroders, it's going to be the BlackRocks, the Fidelities, all of the big boys from the US are also going to have to abide by this rule. So you'll have a lot of capital that has to. I think it goes down again to that sort of consumer demand that's going to continue to push asset managers and client demand that's going to continue to push asset managers to be asking a lot more of their companies. We talked a lot about and Victoria hit on it. There's a lot going on with the DOL and whether sustainable investing, and you would see a lot of the policy rollbacks here be against sustainable and green investing. But actually, if you look at the population of the US, 1/3 of us live in communities that have committed to green policy and or net zero. So you're seeing a lot more consumer and client awareness, as well as this bit. And number 3, it comes down to the economics. I mean, Victoria hit the nail on the head. You're seeing massive disruption. And these are people's long-term assets that are invested. They're going to want to understand what the impact to that asset would be. If you just think about the physical risk we've seen here in the US between the wildfires, I mean, New Orleans is getting hit by a hurricane literally as we speak right now. If you just think about the damage, I mean, and that's on the Greek alphabet. So we're way past what we've seen. So I think those 3 drivers, as it's beginning to cost companies more and more in terms of earnings, revenue, you're going to be continue to have the investor community have their attention and their eyes on it.
Absolutely. Thank you for that. Dave, would you like to, we're at time, but we're going to go over just a few minutes. Would you like to add any additional comments?
Yeah, the only thing I'd like to add is the role of the index providers. BlackRock has taken a lot of flack from both sides for doing too much to try and advance the interest of ESG share owners and not doing enough. And the reality is that they are the major holders of companies. And even though they're not trying to achieve alpha, they're just trying to perform in alignment with the benchmark. Going back to my earlier comments, we as a collective community need to spend more time focused on shifting the markets. And that's where I think the greatest voices can be heard is from these passive investment complexes. And so we are very supportive of them being aggressive in engaging with companies and voting against management recommendations on shareholder resolutions, where the resolutions have an opportunity to align company business practices more with the interests of long-term shareholders.
Excellent.
Well, Alexa, could I just add one more really quick comment? I mean, obviously, with the election next week, I think something that's on people's mind is, what does that mean for pressure on companies to engage in climate policy? And my answer is, no matter what, it's going to be there. I think if Biden wins, especially if there's a Democratic Senate, real policy is going to start to move in Congress. And so companies should either be at the table or plan to be on the menu. If it's a status quo scenario, I think pressure from stakeholders on companies to engage will not let up. It might even increase, and to get involved at the state level, at the regional level, wherever they can, to move policies forward that reduce emissions as fast as possible.
No, that's a great point. curious to see how that will evolve, especially with the upcoming election. Well, just wanted to thank you all. I think, Liam, if you could let us know if there's any incoming questions that we have time to address, I want to make sure we take some from the audience.
Unfortunately, we're up on a wrap for the session now. But there's a lot of questions, so what we can do is share them with you guys and see about a way of getting them answered and sharing with the attendees post broadcast.
Excellent, thank you.
Okay, unfortunately that is a wrap. So thank you, Alexa, Sarah, Dave, and Victoria for an excellent discussion, and yeah, great listening into it. And I do wish you all the very best. Take care, guys.
Thank you all.